If you own a condo and you're trying to sell your condo, your next buyer could have excellent credit, could have a strong down payment, and a perfectly good loan approval, and still may be unable to buy your property. And it's not because there's anything wrong with the unit. It's because the lender may decide that there's something wrong with the Condo Homeowners Association. And thanks to the new Fannie Mae and Freddie Mac requirements, the review just got significantly tougher.
You're listening to the Houses and Spouses podcast with Ryan Hamilton. Ryan Hamilton is a real estate agent with Good Oak Real Estate and the heart behind the I Do Guru, helping people build strong foundations, both in their homes and in their marriages. Let's get into it.
Welcome back to the Houses and Spouses podcast with Ryan Hamilton. I, of course, Ryan Hamilton, local real estate agent here in the Phoenix and Tucson areas with Good Oak Real Estate and wedding officiant with the I Do Guru. Today we're talking about changes to condo financing that every condo owner, every condo seller, and every potential condo buyer needs to understand. But before we get to that sad reality, let's do the dad joke and maybe get a smile out of you. I've heard this one multiple times. I still love it. I think it's cute. So we're gonna go with this one. So why aren't koalas actual bears? Because they don't have all the proper qualifications. It's a cute one. Okay, here we go. Let's dive into this. Here's what changed. In the past, certain established condo communities could qualify for something called a limited review, sometimes referred to as a streamlined review. Essentially, if the buyer met certain requirements, including making a larger down payment, the lender might not have to investigate every financial detail of the condo's homeowners association, the condo association. That option has now been eliminated for loan applications dated August 3rd, 2026 or later. So, we're probably going to drop this in late August or early September. Unless a property qualifies for a specific waiver, generally involving a very small condo development, the lender will usually need to complete a full review of the association. And this is the important part. The lender isn't only approving the buyer anymore, okay? They're also approving the condo community itself. This means explaining things like the HOA's annual budget, how much money it contributes to reserves, its most recent reserve study, deferred maintenance, structural or safety concerns, special assessments, any pending litigation, and the association's insurance coverage. So one of the biggest issues is going to be reserve funding. Currently, Fannie Mae generally requires at least 10% of the association's annual assessment income to be allocated towards reserves during a full review, unless an acceptable reserve study supports a different amount. But generally, it's going to be about 10% of the association's annual assessment income. Beginning January 4th of 2027, that minimum increases to 15%. That may not sound like a drastic difference, but many condo associations already struggle to meet that 10% requirement. And if an association uses a reserve study, lenders must now look at its highest recommended funding level, okay? Associations can no longer rely on a funding plan that allows the reserve balance to get dangerously close to zero. Why does this matter? Well, because an association with insufficient reserves may not have enough money to replace a roof or repair a pool or address some structural issues that are going on with some parts of the community or handle any other major expense without hitting every owner with a massive special assessment. Fannie Mae and Freddie Mac don't want to finance a unit in a community where the next surprise repair could create serious financial hardship for its owners. You see the risk there, okay? Now, what this means for sellers. If you are thinking about selling a condo, do not wait until you're under contract to discover that your association may not qualify anymore. Before listing, your agent and your lender should be asking for the most current HOA budget. They might be asking for the most recent reserve study. They might be asking about information about any special assessments that are being assessed currently or plan to be assessed in the future, details regarding any deferred maintenance or scheduled repairs that are coming up, and any current insurance information that is available. Some condo projects may already have an approval or eligibility status in Fannie Mae or Freddie Mac's lender database, which can make this review a lot easier, but you're going to want to check on that, okay? Others, though, may create financing problems that shrink the number of eligible buyers, and that's really going to hurt. And yes, there still may be options, including portfolio lenders and alternative condo loan programs, but those loans have different interest rates, they have different costs, or they have different down payment requirements, okay? And they're not the traditional product that a home buyer is using. So this does not mean your condo is unsellable. It means that going forward, we need to know what we're dealing with before a buyer spends money on inspections, on appraisals, and on loan fees. Now, what this means for a buyer, if you're buying a condo, getting pre-approved personally, getting pre-qualified is only half of the job, okay? Your lender should also be reviewing the condo community as early as possible if you get under contract, or you're even thinking about it. Hopefully the condo association has that information readily available. Your financing options can vary dramatically from one development to another, even when the units are nearly identical and in the same area, okay? So, bottom line, you may own everything inside your condo, but when it's time to sell, the HOA finances can become your finances, okay? They are going to be scrutinized. The association's budget, reserves, insurance, and maintenance decisions may directly affect whether your future buyer can obtain a conventional mortgage to buy your unit. So if you own a condo and you're even considering selling in the next year, let's investigate the association now. It's much easier to solve, or at least to plan around, a financing problem before there's actual buyer, a closing date, and a moving truck all involved there, okay? We want to get in front of this situation. So, sorry to bust bubbles, and sorry to again, a depressing in a different way potential episode, but it's all about education, right? We want to get ahead of this thing. If you're a condo owner or if you're a condo buyer, we got to start steps right now. All right, as we get out of here, once again, I'm Ryan Hamilton with Good Oak Real Estate here in the Phoenix and Tucson areas, and wedding officiant with the I Do Guru. If you're considering buying or selling a condo in Arizona, reach out before you make your next move. We can review the property, involve the right lender, and help determine whether the association could create some financing problems in the future. And if you know someone who owns a condo, send them this episode. They may own a great property, but the HOA still could be causing some issues for them down the road, and we want to help them be ready for that. Thanks again for being here. This is a short one, but an important one. This is an emergency broadcast, okay? But yeah, we'll check you on the next one. And as always, thanks for trusting us with your real estate needs, and I will talk to you soon.
This has been the Houses and Spouses podcast with Ryan Hamilton. Thanks for tuning in. Don't forget to subscribe and share this episode with someone who needs it. For real estate help or a wedding ceremony crafted with care, connect with Ryan online. See you next week.